Hey, what's going on, guys? Welcome back to my channel. Today I'm going to be talking about my $15,000 M1 Finance portfolio. I call this one Unicorn, and I love M1 Finance investing in general. And on M1 Finance, I have a few different accounts. This one is Unicorn. I also have two more, which are Rhino and Narwhal, which I'll talk about in other videos. When all these accounts hit 20,000, actually, I'm going to make a mega M1 Finance video. And by all these accounts hitting 20,000, I mean this account value plus this account value plus this account value. So yeah, stay tuned for that. It might happen later this year. But yeah, so today I'm going to be talking about Unicorn. I've had Unicorn since June 6th. Before the purposes of this video and just being accurate in general, I'm going to say that this account was created around June 18th because that's when I actually started funding it. And on June 18th is when I put around $10,000 into it. And since then, I've been putting maybe $20 every single weekday from around that time. And then there's been a few big lump sum investments. As you guys can see here, in July 15th, I deposited about $1,000. And then sometime around August 6th, I deposited about another $2,000. And I actually don't have that much cash reserves at the moment. So I'm not doing another lump sum investment unless the S&P 500 goes below the August 6th low. That's the only time that I will consider doing another lump sum investment. But for now, I'm doing my daily deposits. And so the reason why I only do lump sum investments in certain times is because it's a lot more strategic, in my opinion, to invest in that way. And if I were to have done a lump sum investment every single time the market drops 2%, then I wouldn't have enough cash to actually take advantage of the real dips like we saw on August 6th when the S&P 500 lost about maybe 8% in just a few short days. So the other thing I want to talk about in terms of performance is assuming that this account was created around June 18th. If we take a look at where the S&P 500 was on June 18th, let's go ahead and back up a little bit. June 18th is about right here. So we take a look at June 18th performance, and then we see where we're at now. So we're pretty much flat, or 0.26% for the S&P 500. But if we take a look at my account is actually up a couple percent. So that's just a very small sample size. But the main reason, in my opinion, why I'm actually up this much and not flat is because of the dividends earned. And so I actually have more returns in my earned dividends than I do my actual market gains. And so that's awesome because even in situations in which the market goes sideways and goes nowhere, I'm still earning those dividends. And the other really cool thing about dividends is that sometimes I turn my auto invest off using this right here. And what that allows me to do is actually build up a cash reserve. And so I can invest that money pretty much whenever I want. And I don't have to just invest consistently. But of course, this is just another example of strategic funding that I like to do on M1 Finance. So let's go ahead and take a look at some of the holdings. I have two slices. I have a dividend growth slice and I have a monthly high dividend slice. I've already talked about some of these in length, but let's just quickly go through some of the performance on these holdings. Boom, right off the bat, you'll notice that my number one gainer is actually Target. And if we take a look at where Target's at right now, we'll see that there was a pretty huge spike in Target. This was August 21st, so basically just maybe a week and a half ago. If we take a look at Target from a longer-term perspective, you can really see just how huge this jump was. This has to have been one of the largest single-day gains for Target. And so I have no interest in continuing to add to Target right now. I think I'm just going to let Target run and pretty much just focus on my other stocks. But it is super nice to get a really large spike like that in Target. And then Costco is another stock that's also in retail that's also doing really well. 15% on Costco. Let's go ahead and take a look at where it's at right now. Costco is another high flyer, I would say, if we take a look at it from a daily time frame. You'll also see that they had a really huge day not too long ago. But this one was on August 27th, so just a few short days ago. We saw a really big spike. And the way that I see it with Costco is that it's pretty hard to actually get into dips with this one. So even though around June 18th, which was this day, we were still, making higher highs, making new all-time highs, I have no problem with starting an investment in a company that's consistently making all-time highs. And that's because of a lecture that I'll actually link in the description down below. But essentially, this is something called momentum, and basically stocks that tend to perform well, let's say over the past, few years or something like that, tend to perform well over the next few years. And that almost sounds kind of counterintuitive because we'd expect that stocks that perform worse over a given time period will tend to recover because there's something called reversion to the mean, which actually does exist. But momentum is something that also exists, where once again, stocks that perform well over a given past X time period, like 2 years or 2 months, whatever, they tend to perform well over the next 2 months or 2 years or whatever time periods you're looking at. And there's a lot of studies done on this. And so I definitely like momentum investing. And not to get too deep into the topic, but generally, just in summary, I like to invest in stocks that are doing well because they tend to continue doing well. And so we know another example of this one would be something like Visa, which I don't actually own in my unicorn portfolio, but I do own Visa in my other portfolios. And this is a perfect example of momentum investing. All right, moving on to Kellogg Company. So basically, with Kellogg, I saw a really good opportunity, and I'm happy that it's actually paying off. So if we take a look at Kellogg from a long-term perspective, we can see that we're coming up against this green trend line. We're also retesting the 200-month moving average. The main thing that I really want to emphasize here with Kellogg is that I saw a lot of similarity to another company called General Mills. Now, one thing you'll notice about General Mills is that they have a really similar history. And at this point right here, sometime around the end of 2018, we were also retesting this 200-month moving average. And it's the first time that we actually touched it pretty much in all of its history. And so you better believe that's going to be one hell of a buying opportunity if a company as large as Kellogg's or General Mills is retesting this moving average. And so very fortunate to actually take advantage of General Mills a little bit in my other portfolio. But as far as Unicorn goes, around the time that I opened up Unicorn, General Mills has already started its recovery. And so I looked towards Kellogg's because we hadn't made that recovery yet. And as you guys can see, we only started to show really strong bounce towards the middle of July. And so I actually opened up my account here towards the middle of June, which was around here. And that's because I saw that Kellogg still hadn't started its ascent yet. And the other really interesting thing about Kellogg's and General Mills is that if you take a look at their balance sheets, their revenue and net profits are actually pretty similar. Their operating margins are actually pretty similar. And the products that they sell are actually pretty similar. And it just didn't make sense to me that General Mills was recovering. And you have channels like PPC Ian that are saying that General Mills is much more diversified, just so much better. But Kellogg's, I didn't think was that far away in terms of performance. And this is kind of one of those situations where we let stock prices kind of determine our opinions on a particular company. If a stock is performing well, we assume that internally they're performing well. But that's not always the case. So yeah, when comparing them side by side, I thought they were pretty similar, and I thought it was a good buying opportunity, and it's paying off now. Cool. And so yeah, the other thing I really want to point out is that some of these retail stocks are just really killing it. Like we talked about Target, we talked about Costco, but there's also Home Depot, which is up 11% since I bought it. There's also Walmart, which is up 6.83% since I bought it. And I don't have that many retail stocks, but it's interesting to see that they're among some of the best performing stocks. And then some of the other stocks are like Procter and Gamble. This is probably like one of my favorite stocks of all time. We also have Cincinnati Financial Corporation. Cincinnati Financial Corporation is a dividend aristocrat, and this is one of those situations of momentum investing as well. And so I really liked how strong this one has been pretty much over the past, I want to say maybe 8 months or something like that. So towards the end of 2018, CINF was here around $71 per share, increased by about 57% over the past 8 months. So that's massive growth. And because of how M1 Finance works, my allocation is actually more than my target. So pretty much it represents 3.2% of my portfolio, whereas I only set it to be 2% of my portfolio. So basically, I'm going to focus on other stocks instead of CINF, but I really like seeing this capital appreciation. And so the main topic of today's video that I would say, aside from just doing a simple walkthrough, is a discussion on value versus stocks that are already performing well. And so, in my opinion, there are some types of investors that only want to invest in value, and there are some types of investors that only want to invest in momentum stocks or growth stocks or really strong stocks. I don't do one or the other. And so, actually, my brother, he pretty much only wants to invest in value stocks, which is fine if your goal is dividend income. Personally, that's not my goal. But the other thing I really want to point out is that you never really know what's of value or what's a true bargain, especially if it keeps on going down. And so you might have a situation of something like GE, where back in the day, people thought GE was probably one of the most reliable companies of all time. There are other examples of companies that you think they're probably one of the most secure and stable companies, and so you kind of buy the dip, but then you realize that wasn't the dip, and that there's way more dip to come. And that's another topic that I want to talk about as well, is that if you go all out on these value stocks and you don't kind of diversify, then if it ends up being the case where they just keep on going down, well, you have already invested all your money in these value stocks. And so you might not have that much more to take advantage of the dips. And if you do start to add more, then these positions actually become huge parts of your portfolio, which may not be something that you want. And again, this is just speaking from my experience, but I started investing in 3M a little bit later to the party. And so with 3M, I'm actually only down about 2.88%. Whereas if we take a look at where it's at right now, from its all-time high at $258 per share, we're currently about 37% down. And so had I been buying 3M around this period or around this period, obviously Unicorn wasn't around at this point, but even in my other M1 Finance portfolios, I didn't actually start investing into 3M until after we got a huge dip. And so if I invested early in this one, then whenever we do see more drop in 3M, this allocation will be way more than I actually want it to be. And so one thing you'll notice about this portfolio is that if I sort by my target, then you'll notice that the highest amount that I allocate to any one stock is actually just 4%. And I never want a stock to be maybe more than like 6% or something like that. And so this allows me to have more control over the stocks that I have and how much I own in each stock. And so yeah, you'll notice towards the top you see something like 3M, you'll notice Caterpillar, Coca-Cola I just think is really reliable and pretty much always a good buy. And I think that we might have another leg up in Coca-Cola soon. So that's why I have another 4%. Colgate Palmolive I love as a stock, probably one of my top 5 favorite stocks. And then yeah, you'll also notice the next 2 stocks are actually value stocks. So like Honeywell International, a really strong industrial company, I'm down 5% on it, and I want to keep adding more to it. Johnson & Johnson, I'm down 8% on it, but I want to keep adding more to it. And so if I once again sort by gain, you'll notice that about half my stocks, maybe more than half, maybe like 60 to 65% of these stocks are all green, whereas the rest are all red. And I want to keep up that ratio. Again, if I invest in stocks that are always red, then I won't really have the opportunity to diversify in the way that I want to. So yeah, I think this video got pretty long, maybe longer than I wanted it to be. I do have more stuff that I want to talk about, but I'm just going to wrap it up here. Thank you guys for checking into my channel. I really appreciate all the support lately. And yeah, hope to see you guys in the next video.